Hey, folks. Good morning. Let's go ahead and rock and roll. Um, if folks haven't figured out, all the good music that is on this show is because we have Debbie making such good recommendations. Any bad music, by the way, you can attribute to me, songs you don't like. But in any event, Dolly Parton this morning, very appropriate on the day. And we'll get right into things. Canada went ahead and hit back at the United States. $27.5 billion of U.S. goods that will be tariffed at duties of 15, 25, and 50%, uh, just corresponding to the American rates on steel, dairy, appliances, electronics. Um, those start on September the 8th. And um, in additional news overnight, before we get into the thick of things this morning, we have PCE coming out at 8:30, so that will be the linchpin of the show today. But in advance of that, we'll talk a couple of other things. Meta, rumored to be in discussions on a settlement with the 29 states that are suing over the harm caused to young users by Facebook and Instagram. Um, the settlement amount being thrown around is $200 billion or so in damages. Um, we'll see where we get there. But nevertheless, at least they are talking, um, and they're not upset about being in discussions. Um, then we've also got a couple of earnings that have happened. First of all, yesterday, as we stated on the show, Dix was down. It ended down even bigger than when we left the show. Largest fall on record for that stock, down 30%, due largely to the underperformance in Foot Locker. And I've said, even when the acquisition was done, I think we discussed on this show um, the questionability of the acquisition. You know, Foot Locker was not in a good place to begin with. The sneaker retailing business certainly is not in a good place. We've been over sneakered for quite some time. Nike has its own set of issues as a manufacturer. And all that being said, it seemed like it was for Dick's. Dick's was coming off of some pretty strong years, especially during COVID and post-COVID, because of everything being done outdoors and a reinvigoration in outdoor activities, coupled with the fact that now a ton of money is spent by parents on training their children like they're going to be professional sports stars. And so all that leads to a lot of money being spent inside of Dick's. The Foot Locker add-on really didn't make a lot of sense. Um, it wasn't a necessary bolt-on. That took a very, very long time to translate finally into an earnings period where that was blaringly obvious, and now the stock has taken a hit. Lesson to be learned from this is it's all about timing, folks. We did have that commentary here when the acquisition happened, but it took an incredibly long period of time before that showed up in the movement in the stock. Um, and I haven't looked, excuse me, forgive me, I haven't looked at the stock performance from the acquisition through yesterday. So I don't even know if you would have made money if you would have shorted it the whole way through. Um, Other stuff, we've got NVIDIA after the bell today. I know there's HP, Salesforce, CrowdStrike. Um, Kohl's reported earnings, stock down a little bit in the pre-market, about 4.5%. Tariff refunds have done well for them despite having light revenue. And even though they did top their profit expectations and raise their guidance, nevertheless, stock down a bit because of the revenue. And then Abercrombie and Fitch reported a strong quarter with strong guidance. The stock is up 12% in the pre-market. As we get to the very end of August, um, only the worst of companies, I believe, in my experience, report at the very end of earnings season because it coincides very often with people being away from their desks. The very end of August, nobody's around. You've got Thanksgiving, nobody's around. You've got the end of December, if you report then, nobody's around. You've got spring break, nobody's around. So some of the worst companies report at the very, very end of earnings season. In more retail news, and then we'll get to the meat of the show. Target once again offsides on promotions. Justin, I need your help on this one. I don't know if you saw the Halloween costumes that they went ahead and advertised, but apparently they are quite offensive. There's a kid's circus clown costume, and they're getting accused of selling racist merchandise. I mean, these guys just can't get it right, no matter which side of the aisle they're on. I don't know if they need to hire somebody that really gets this stuff, and it's a separate position for every single product SKU that goes out on the floor to make sure that it is not offensive. But Target, in the midst of a turnaround, and as Dave Nikoski has told us, has done on a relative basis much better than Walmart has done. Nevertheless, fundamentally on this company was once again caught offside. Oh, I'll stay in apparel for a second. There is a fair amount of reporting going on about finally we are getting to the GLP-1 effect on clothing, and that plus size clothing is really going away. There are expectations that 15% of the population of the US population, 55 million Americans, will be on GLP-1s by 2035. Biggest beneficiary of it is Eli Lilly. But that plus size clothing, along with that, is going to go away. And so retailers, especially plus size retailers, are going to have to go ahead and modify. Um, Before we get to PCE this morning, Brandon, I think we need to talk about the open AI departures. And this show generally has been, I would say bullish open AI, more uh, critical of Anthropic. But Anthropic has not had nearly the same amount of departures, or at least high level departures, as OpenAI has had. And OpenAI has had a slew going into a period of time where it would be critical to have really good and important high level people, i.e., the IPO. So, Brandon, as a bull, how do you square the circle and get comfortable in spite of all of these departures?
Yeah, I mean, again, I think what I would say on it, the biggest departure I think recently is Chris Malone, and he was kind of their head of data centers. And now we've had this data center conversation here quite a bit, and I've made my feelings known on it. I think that that is probably maybe one of the most stressful jobs that they could do. So. um, yeah, that's a tough one. I mean, I think that that's going to be a big hit to them, more so than most of the others. Some of the other ones you've seen, they're salespeople. So there's that, and then I think that there's again, we talk about this ideological difference between OpenAI and Anthropic. And the other day, a story came out about Anthropic. Part of their interview process was asking people, how would you feel if this company went to zero, soon or something? And so, yeah, just weird questions like that. And they're hiring. I almost said sickos. That's not the word I'm looking for. They're hiring sycophants, like people that just they want to work there. Um, and not sickos. Please don't anybody come and attack me over this. Sycophants is what I meant. They hire people for specifically like mission, and I think that just plays a big role. OpenAI is a little bit different of a company. Not that they're not hiring people for mission, but that's not like their biggest thing. They're not giving out Bibles to
Hey, Brandon,
everybody at the AI
quick
Bibles.
question.
Yeah,
When these people leave at this phase right before the potential IPO, do they lose their opportunity to vest and hold shares that they would have gotten for their time in the company?
yeah, that's a great question. So I believe that OpenAI did move their vesting to a 2-year schedule. So if they were there 2 years or longer, then no, they keep it. Someone can fact check me on that. I can't remember this. This was probably 6 or 7 months ago that they moved it to a 2-year vesting schedule. So it really depends on the contract and when the person signed up and whatever their schedule looked like at that point. Typically, it's about 2 to 4 years, I would say. So the people that are there in short order, yeah, I'm sure they're losing their equity in that. Which more power to them. I don't know if it's just extremely stressful or what.
Yeah,
But there's actually there's something else I want to talk about in a little bit once we get past this conversation if we get a chance.
yeah, I don't know if someone that is requesting to come up knows the answer to this question. But it was reported in late 2025 that the company eliminated vesting cliffs. So what you can contract anything is the bottom line. The question is what is A, the industry standard, and B, did the company have any particulars around this? And so usually um, they can usually there is a certain amount of equity that vests no matter what. um, it is very onerous that even if something quote unquote vested, you lose it when you leave. I mean, that's essentially a legal oxymoron. Then it didn't vest. What usually happens, though, is there is some sort of give back, maybe on your departure, even of stuff that has vested. You don't get to leave with 100% of what has vested with you. Um, and so, it's all about competition for talent. But your point, Carlo, is well taken. I'll just say this, the quiet part out loud, which is if people are leaving a bunch of stock on the table, then you get really concerned, right? That's worth potentially millions, if not tens of millions of dollars for some of these people, maybe more. So you get really concerned about, hey, what the hell is everybody going to do? Is someone making them a much better offer? I mean, all these people have incredible non competes. They probably have garden leaves that they need to sit on before they could go with a non compete. So that is, that's another question to be thought about, right? It's not only the talent drain or the brain drain, but it's also about even if I hated my job that much, and even if somebody else offered me something that seemingly could be much more lucrative, why would I trade the bird in the hand for something else that I really don't know, if it's going to materialize, especially if OpenAI's, IPO may be less than 12 months away. Let me go to Lumi, then go to Eladio, then back to Brandon.
Yeah, morning. Thank you, David. Hello, everyone. I want to give you this example. You shouldn't really trust like one or two exits because the signal could be off. For instance, NVIDIA 50% of the employees are millionaires as of today, but one employee decided to go and smuggle chips to China and got caught. So, on the overall scale, a lot of them are very wealthy. Why would they do such a thing? Probably might even be a millionaire, but he decided to do something very stupid. So, everyone to their own. You can't always assume someone's doing their most economic best interest at heart always.
Yeah, let me just go back for a second. I might not have been clear on what a vesting cliff is. A vesting cliff is it's a bad moniker, to be honest with you. It essentially is a hazing period or a sideline period before you could get your equity to start vesting. They eliminated the competition for talent was so fierce that OpenAI needed to eliminate the fact that you needed to have some sort of gray period or sideline period before you could start to get your stock. In fact, now your stock starts to vest on day one. So therefore, back to your question, Carlo, these folks, even if they leave the company, some portion of their equity is theirs. They don't have to give some portion. They don't have to give back at all. They will take it with them upon exit. But go ahead, Eladio.
Real quick before we get to Eladio, another point here is that OpenAI's equity, this isn't normal. It's been very liquid, right? Like a lot of secondaries have been sold. So we have to remember that. And then also, it was just a month ago that OpenAI did a buyback on equity. So a lot of people, I think we talked about it, the median was like $5 or $10 million. So that was a lot of people got some cash out, cash in hand, and that could lead to why they left as well.
Awesome. Go ahead, Eladio.
Okay, IPOs take longer now. Now, not only do they take longer, but they get to letter Z, private financing, and they want to squeeze the lemon dry. We've had at least, I don't know, 15, 13, 14 departures out of OpenAI in the year, during the year that they were supposedly going to file for the fall. But now we know that's going to be pushed out into 2027. And now we have, more departures. Obviously the head of data centers leaves. There's also, as you well know, like everything else in this country is bipolar. It seems it looks like the Democrats are going to use the AI data center boom as a weapon against the Republicans in the midterms, at least with their rhetoric. And you've seen all the things that are happening, even in the state of Pennsylvania, which is not exactly what I would call a blue state in any way, shape, or form. I mean, it's definitely a purple state. And I'd say, well, it obviously leaned Republican the last time. So we're looking at a lot of things that are happening. And I don't know, did you see a lot of people leaving Meta right before the Facebook IPO way back in 2014? Or whenever it happened. I forget. It was actually even earlier, that 2012. Did you see a lot of people leaving right before an IPO? And again, I'm sure everybody has their own packages. They're all different, and all employees aren't treated differently. But we're seeing, and I've mentioned this so many times, that compression of cycles has gotten to such a point that we have what we call ever changing, it seems, business plans in the AI world. Because first of all, they can't figure out pricing. We all know that scarcity of capital exists. I mean, I don't know how the heck a $2 trillion IPO is going to be assimilated given the scarcity of capital that we see with rates obviously going up. It's not an ideal time for a company to go public. Historically, investment bankers, and I think Goldman Sachs usually does this the best. Timing is everything, right, David Talo? You want to make sure that you're not entering the market at the peak of the cycle, and I think a lot of the delays that we saw in the IPOs here came after the fact that, let's face it, SpaceX timed it perfectly, and they sucked the air out of this market. So the market's going to have a pause. have the last $1 trillion IPO recover or go back to its IPO price like SpaceX before the next one could come. Do you see the problems we're creating here with the scarcity of capital and IPOs coming out at later stages? Something's not clicking here, right? And I don't know that the market is ready to assimilate that type of new dilution with more shares of new companies that are worth a trillion or 2 trillion that aren't going to be in the S&P 500 for a year. Made my point, I think.
Yes. Let me, David Koski, before I get to your hand, let me get back to Brandon, and then we're going to talk more about the money, right? How much money? Because there was a couple of statistics came out overnight about how much money we're talking about all around here. But first, Brandon, go ahead. Next point for you.
Yeah, I was just going to touch on this H-1B conversation. I don't know if we got a chance to talk about it yesterday. I can't remember, but it's kind of exploded on the timeline, especially in tech circle, because of a Y Combinator partner or president um, basically saying that they wanted to bring in more H-1Bs, and he made some derogatory comments about flyover states or flyover country. I don't know. Basically saying places that aren't San Francisco or New York or whatever. And this is a really important conversation. A, because of a lot of the tech companies hire H1Bs, and it seems like now the president is looking at, or this administration is looking at putting a higher fee on H1Bs. That's going to affect tech a lot. Everybody can have their own personal opinion on it, whatever that may be. But I think that, I praised YC the other day and multiple times on this conversation. And at this point, I think that I'm going to, I call balls and strikes, or at least try to. I'm going to say that I think that they're making a big mistake here. Um, it's just like, check the temperature of the room. I don't know. But a lot of Americans are upset with tech. They're upset with the data centers. They don't like being talked down to, and it seems that the biggest and the best accelerator program in the world, to have a partner or a president, I don't know which one he is. I think it's Ankit Gupta, come out and say that they need more H-1Bs, and to talk bad about Americans is just it's a really bad look for them. And I think that now he's fighting with, like, the FTC. He's fighting with JD Vance, and then made his profile private. So I guess that more people couldn't go at him. But yeah, this is going to be a pretty big moment for tech. And my personal opinion is I think that we should always train American employees first. We should always train Americans first. We should be putting Americans first. If there's no American for the job, then that's what the H-1B is supposed to be used for. However, the system has unfortunately been abused over the years. And I think that when we see all this negative talk about data centers and stuff, it's not just about the water. It's not just about the electricity. It's that the average American in these quote unquote flyover states just it has a strong dislike for tech, because these tech leaders have such an air of arrogance, that they speak about the people that they're trying to sell their solutions to. And I think that if we're going to really change the perception, it has to start with the tech leaders. It's not going to start with the politicians. It has to start with the tech leaders who are out here just spewing this absolute nonsense. So I'm not happy with what Ankit said. It makes my life harder, makes my job harder, makes it more difficult. And when I, go and try to talk, I posted the other day an email that I sent to Governor Josh Shapiro. I've reached out to his office now, and we're setting up a conversation about data centers in PA, so I can try to give some stats and facts. And I guarantee this will be thrown in my face whenever we have that conversation, that this is what tech thinks of Pennsylvanians. And so that's it's an unfortunate conversation that he had to start.
Thank you for that, Brandon. Let me throw in just a couple of other numbers, and then I'll get to Dave's hand, and then the rest that are up. So as I talked about last week or the week before regarding Anthropic's IPO timeline, managing that communication gingerly is of critical importance to continuously feed the market more and more, I don't know, uplifting data. So the leak of last night was about that Anthropic is likely going to pitch the market on a $30 trillion total addressable market for for their business. Again, we now know they're going to go for a $2 trillion valuation, and they're going to raise $100 billion. In addition, came out overnight as well. Someone went ahead and tallied all of the quote unquote off balance sheet liabilities that exists amongst the Mag Seven. So we've got seven big tech companies, not the Mag Seven, Google, Microsoft, Nvidia, and so on, have committed. Why it's called off balance sheet, folks. For those that don't know the term, it's not necessarily a nefarious term. It's simply that it doesn't show up in your long-term liabilities on your balance sheet. You have pledged to invest a certain amount of money or to buy a certain amount of product or to collaborate on a certain project. And so therefore it doesn't appear on your balance sheet because your counterparty most likely, can't go ahead and sue you into default for not, depending on the wording of the contract, but they probably can't sue you in the same way a direct liability in terms of borrowings like a bond or bank debt can. In any event, that number is $3 trillion. That is beyond the formal debt that sits on the balance sheets of these companies. So the numbers are big, folks. I quipped last night that we'll soon be starting to talk in quadrillions. I assume it'll happen in my lifetime. But multi-trillion dollars is what we do these days. So let me get to Dave Nikoski. I'm sure we'll go ahead and add to that. Please, Dave.
Yeah, well, you stole my thunder because that was my topic. I posted it on my timeline yesterday. Why not just make it 50 trillion? And just to give people a back of the envelope number, the entire population of the planet, that equates to $2,470 per person spending on AI. Like, are we going to have Aborigine, tribes, start to subscribe to AI? Like, the same thing happened in 2000. Analysts came out and gave Qualcomm a $1,000 price target. At the end of the bubble, someone went through and at the margins they had, in order to get there to be a reasonable valuation, you would have to sell 7 cell phones to every person on the planet yearly to infinity, right? Like, robo taxis, that's a $30 trillion business. So right now, the GDP of the United States is 33 trillion, to give people an idea. So we're going to more than double the GDP in the next year, and pretty darn close to it. And everyone's going to spend 180%. Even if Open AI or Anthropic got 100% of the market, like, and that's the TAM they're suggesting, right? That it's going to be any AI company. I mean, why not just make it 50 trillion, 100 trillion, and we'll be able to get this thing out the door and it'll sell like hotcakes, There's reasonable expectations that an analyst should have. And going back to your off balance sheet, have you looked at the credit default swaps and CoreWeave? 780. There's a 50% chance they go bankrupt. And that's not and you can, hedge your portfolio as an asset manager and play with the credit defaults, to uh, in other words, to, manipulate the market. But I mean, that's egregious. 780 basis points. What are their yields right now? 12, 13% on their debt? That's like beyond junk.
I'm sorry.
But
I'm sorry to have stolen
this
your.
is the market,
I'm
right?
sorry to have stolen your thunder, Dave, because
No, that's
you
okay.
deliver it a lot better than I do. So I appreciate it, folks. If this all ends up unraveling, don't ask how come or why. Andy Kaufman, I assume you have PCE numbers, so go ahead.
Yes, sir. Good morning, everyone. So coming in hotter than expectations. We're seeing a 3.7 PCE year on year. Core came in at 3.3, which was what was expected. The year on year was 3.6 estimate, so we came in at 3.7, 0.2 versus 0.1 month on month. I don't think anyone didn't expect this to come in hotter, especially with the war picking up and inflation and other tariffs and things starting to come into place. Factor in prices of beef and other types of knock-on effects. Pretty much what the market expected, I would say. GDP came in at 1.5%, and personal consumption came in higher than expected at 3.4. So look, this puts us exactly where I think the market expect. Last I looked, we were up about 2 to 3 basis points across the curve, more on the front end than the back end. It's going to be interesting. So we got Warsh on Friday, and what's he going to say? These are metrics. He said it's very clear that 2% is his target. So it's going to be hard to walk around these numbers and say that this isn't a trend, and that's what he wants to see. He wants to see trends, not specific data points in specific intervals, but trends of where we're going. The trend has clearly been higher or at a higher level than 2%. So something's got to happen, but we'll see. We know he doesn't want to move, and his goal is to remove the Fed from the market as much as possible. Back to you, Dave.
Super. Thank you, Andy, for bringing it to our attention. I'm sure Dave Levinson has comment on that. Dave, hang on there 1 second. And Andy, while you're driving, even through that spotty patch, don't speed up for us. Let me go to Eladio, then to Lumi, then I'll get to Dave Levinson. Go ahead, Eladio.
All right. Because people have trouble understanding numbers. The magnitude of the numbers isn't just what we're talking about, David. Both Davids, and David, you're so good at making things that could be bad seem not as bad because we've been there before and there's intervention but let's really look at what we're talking about. I'm going to just choose Anthropic. I'm not picking on them. They are the best. They're the one I use the most. And I try to use Fable 5 for everything, which is as far as I'm allowed to go at this point. And it's an incredible technology. Okay, it's saving the life of a family member. Some people in this room know what I'm talking about. I'm telling you, it's really truly going to change the world as we know it. But there's something wrong, guys. When we have an IPO coming in at $2 freaking trillion, and 5% of it is really the IPO because the other 95% was there through all the cycles of funding that they had before going public. And now, look, I'm a free capitalist. If after 200 years there's a better way to finance companies higher than what Goldman Sachs could do with an IPO, more power to them. But that's essentially what we're talking about here. The private debt and private equity market is the market. And I know, as everybody here knows, these markets are not opaque. So the individual investors that listen to this show aren't equipped to handle the what that means. Okay, you have to know exactly what you're doing. In many ways, again, I'm going to be honest. You got to be careful with, not everything's going to be anthropic. The seeding, when you seed something, you're signing up to something. But a lot of these fails. A lot of these angel investing companies, they just fail. Okay, so we have these companies, and we have a $70 trillion S&P 500 that are coming in at weightings that we once associated with Apple and Nvidia, and they were the biggest companies 5 years ago at those So do you see where I'm going here? The IPO is only 100 billion, really. The rest, the 1.9 trillion has already gone in. The seed capital, the Sean Parkers and the Thiels. There are too many of them now. They're the ones that control this market earlier because they're the ones that go into every hot investment before it gets hot. And this is very different for a market to assimilate. And it is a problem. It is a problem for a $2 trillion company to come out. And I know 100 billion is more than the 78 billion. After the green shoe, it was about 83 billion, I believe, that was raised by SpaceX. But what happened to the stock? Boom, back to 135. And is that going to happen? Are we going to have, I guess that's what we're going to happen. I guess that's what we're going to have to expect. But there's going to be a lot of blood for all those individuals that think that they understand what's happening with the way these companies are coming out now. They're just totally different.
So you're not putting your clients into Anthropic stock, I assume.
No, nah. Again, me is a different story. My company's business, money, a different story. Okay, because I'm different. I have the capital. I'm a seasoned investor. But for wealth management, only clients that are at levels that are higher, 5 million, 10 million and above would be in that type of market. Now, do I have access already? I have. So does that make sense? I have access because I got access before through private debt and private equity. Does that make sense?
Totally valid.
But I got in at lower prices. I got in at lower
Okay,
prices.
okay. Lumi, over to you.
Yeah, I just wanted to mention this while we're talking about economic data and things like that. The Treasury auction yesterday was very strong. And I wanted to bring that to everyone's attention because we were talking about that for a few days in a row. And it seems to be very strong yesterday. And they had no problem with the auction and everything went absolutely fine. So just wanted to point that out.
Thank you.
You asked a question. That's the problem. The smart money's been in. When did I start buying private debt? I've said it many times. Duh. And from 2018 to 2020, when rates are at zero, why would you want to own a bond when rates were at basically zero after COVID? I'm out. I was a bat out of hell. Just to see how bad the corporate market would be. I kept Kraft and Boeing debt that I bought after the stock collapse and the stories hit, and it still hasn't recovered to par. Fixed income was a waste. I got lucky enough to get into private debt early enough. I've been exiting it, but I haven't exited on the side of those IPOs that I got exposure to before through private debt. And that's where private debt has been very good for my wealthy clients and myself.
Thank you, Eladio. Levinson, to you, sir. PCE and anything else.
Yeah, thank you for having me on. I did post a couple of things in the nest. One of them is I had one of my team generate some animation describing what Warsh did and why the curve is flattening today when it would be steepening under Powell. We got hot data, so you'd think people would say, hey, let me short a bond. Not good. And so the mechanics of what goes on is this. Every time there was a tail event, something extreme in terms of price change in the 2-year, Powell would come in. And that's the last post that I did. It shows the 3-year trend line of the difference between the 10-year and the 30-year, because obviously the 30-year is more sensitive in one sense, the yield, to longer term structural changes. And what you can see is the 30-year, with respect to the 10, is about to break down all of the policy interference, all of the over easing. Remember, Warsh likes Greenspan. What did Greenspan do during .com? He did nothing. He allowed the NASDAQ to fall 57 basis points in a gestation in 40 weeks with no rate cuts. He let the yield curve invert from policy to bonds 134 before he cut without warning on January 3rd, 2001. So how is Warsh different than Powell? When a tail event happens, he's going to let it happen. And the market's starting to demonstrate it sees that. So in the most recent thing I posted on the left side, you see we're about to breach that 3-year trend line. And on the right side, you can see it's been a year since the 1030 or the 10.3, excuse me, the 330 has been flattening. And when you have a bond yield declining with respect to everything else, ignore everybody. That's pure truth. That's pure fact. Because when bond yields go down in yield faster than a 10-year, it's acting like a juice press that squeezes duration out of mortgages, forcing this flywheel where 13 trillion of mortgage asset holders are mechanically required to buy duration. And if I could distill it in one phrase, the world thinks we have a glut of duration, and our model says we have a shortage of duration. And we had a temporary period of Powell accommodating AI by suppressing the dollar, and Warsh ended that. So we expect the yield curve to reinvert. We expect it to drive mortgage bonds up, prepayment speeds up, and that's going to overload these liability driven investors, the annuities, the insurance, the pensions. And they're not going to be buying this toxic waste from Guggenheim. As Nikoski put up, the spreads blew out. We said yesterday, NVIDIA should transom 85. It's at 86 and change.
David, Brad
It doesn't
Stacks, I have a
matter what they
question for you. David, I have a question for you. It's very important. Do you believe that Warsh and Besson are working against each other or together?
No, they're working as a team. They did it perfectly. What he did is Warsh said, I'm going to let the kurtosis or the volatility of volatility, the super tail events, I'm going to let them happen until it's an actual emergency. I'm going to take some of the stability, some of the volatility suppression off of the short end of the curve. That's the video I put up there. And then they waited for every clown, schmuck, and fool, including Druckenmiller. I no longer call him that intoxicated Miller. They're all angry. And people think, oh no, this is just a corrective action. We have been flattening without either of these folks for a year since September 2nd of 2025. Look at the prices, look at the charts. And now War says change of regime, change of policy. I'm going to tolerate the volatility to build up in the 2-year, whether rates go higher in the 2-year, whether rates go lower in the 2-year. I'm not cutting, I'm not hiking. And draining the swamp, draining the volatility out of the bond. And I put up a handwritten chart showing what a primary dealer versus an individual option buyer, those oppositional positions. And it says that when you short volatility, you're also shorting gamma, which is price movement. But the lower the volatility goes, the more gamma risk or price risk you have. And that mechanically means you've got to buy more of the gamma. Now, when bonds are low and cheap at a 4, 5, 6-year low, the buying of the gamma means buying the bond. When you're overpriced, like 2021, when 2020, when we're at 1%, buying gamma means shorting it because it's a duality, it could be either direction. So when you're seeing VXTLT go down, and you see the MOVE index about to enter one of the most powerful things you could possibly imagine, a monthly death cross. And I have a personal dinner bet with the guy who created the the MOVE index, Harley Bassman. I think it goes to new lows. He thinks it stays higher. We're going to lose volatility throughout the system because all of this AI and data center, it's negative duration. The worst thing that Kathy Woods ever did, in my opinion, was tell people that she buys long duration assets. I want to correct her. She buys long negative duration assets. So as you see equity go up, as you see volatility go up, it's an embolism, it's a clot. And now Warsh is saying, I'm going to dissolve that clock. I'm going to let equity go down, and I'm going to let that money go into mortgages and treasuries. And the lower rates go, mortgages stop acting like debt. They're covered
Hold it
calls.
there. Hold it there,
Okay,
Dave Levinson, because I want to
sure.
get to Carlo's hand. Carlo, so if inflation is sticky, can Warsh cut? By the way, Dave Levinson, you better be here next Monday after Warsh speaks
I'll
on
try to
Friday
be
to
here every day.
discuss.
He's not going to say anything. He's not going to say anything. He's not going to
Okay,
say
okay. Well,
anything.
we'll do a
But I'll
recap
be
on the
here, but he's
say
not going to say
nothing
anything that
speech.
moves the market.
You got it. So, Carlo, first of all, will Warsh be able to hold, if not cut, on the rates? I also want you to talk about, might as well, Coinbase considering leaving the state of California because of the assault on wealth. And then lastly, I want you to talk a little bit more about the tokenization of everything, because that seems to be a stronger and stronger theme as the days go on, and anything else you want to hit on. Good morning,
Good
Carlo.
morning, David. Good morning, everyone. I still cling to the position, I hold the position that I believe Warsh and Bassett are in a coordinated effort here, especially going into the midterm elections. And I don't think he will do anything to disrupt the growth trajectory that we're seeing right now. Um, I I would suspect they stay neutral because it's going to be very difficult, if not impossible, to justify a cut unless we see some kind of an urgent crisis. You know, the Coinbase story is interesting. Leaving California is just typical. That's what Elon did with SpaceX and Tesla. And it just continues to demonstrate how California is really becoming a very hostile environment for business growth and development. And long term, that cannot be good for the state. But the bigger issue that's happening right now with respect to Coinbase is there was an announcement that they have entered into a collaborative arrangement with Bitwise. And my friend Hunter Horsley at Bitwise, who's very, very crypto centric, today Bitwise announced it's launching an automated token portfolio, institutionally designed model portfolios for tokenized stocks that live directly in your crypto wallet, powered by none other than Coinbase. So tokenized stocks are coming, David. That's been no secret. They're not waiting for the vote on the Clarity Act to do this, which is, again, what I've said is regardless of whether the Clarity Act passes or not, clarity is coming to crypto. The regulators at the SEC and the CFTC are making sure that this does not fall off the agenda. And this announcement by Coinbase is huge. Crypto assets continue to have a very strong run here. Bitcoin continues to stay around the 78,000 mark. Alts are moving. Meme coins are absolutely going crazy right now. And the reason I bring up meme coins is because the liquidity that comes from these insane meme coin gains generally flows back to crypto. So you're going to see a massive influx of new liquidity from these profits and meme coins rotate into altcoins, NFTs, especially the high-end collectible art from the last cycle, is starting to see a lot of interest. A lot of floors are getting swept. A lot of new mints are coming out from established NFT artists. And that is indicative of a real indicator that we're coming into a legitimate crypto bull run because profits, again, from meme coins and these alts and what's happening tends to rotate into art, collectibles, watches, etc. So the cycle is playing out as it's played out previously. And another major announcement that we have to touch on is X is announcing that they're going to integrate a crypto buy and sell button. You know, X recently partnered with a bank, created X Money, and offers very, very competitive rates on moving money. I was wondering why they didn't go stablecoin adjacent, but now it's becoming clear. You are seeing incredible volumes across the board, both in Robinhood's on-chain activity, in what is happening with Pump Fund and meme coins, what is happening in general crypto markets. And now you're opening the door to 500 million X users to simply move crypto assets at the push of a button on their X app. And it's always been the understanding that crypto is not going to get true mainstream adoption until moving crypto assets for consumers is as easy as opening your iPhone and pushing send on an app. And that's happening. So I don't think anyone is sufficiently bullish on what is going on in crypto right now. And I think that the tokenization of every asset is going to create tremendous mainstream interest and adoption of this stuff. And I think people should plan accordingly for that and be mindful of that. I also think, in touching on Eladio's point before I pass the mic, I don't think that Anthropic or OpenAI are going to see the same liquidity drain that the SpaceX IPO caused. It's just my hunch, but I just don't think we're going to see that type of rotation this time around. And I do think that there's a lot of overvalue in those that is going to be reckoned at the time of the IPO. Back to you, David.
That's a great point, Carlo, because there's a lot of time between those IPOs still, especially the open AI.
Thank you, Carlo. Let me tie up everything said until now in the following. Stan Druckenmiller, who we spoke about yesterday, who gave some criticism of Scott Bessent, owned up overnight proudly owned up overnight to using AI to pen his opinion piece. And his quote was as follows: "The reason I use AI, hang on, let me get it. I write everything using AI now for the same reason I use a calculator when I do math problems." And he's totally right. So Stan Druckenmiller, brought up by Levinson, and a couple others thus far in the show. AI spoken about at length. Druckenmiller was an early crypto investor, will continue to be, and obviously using all of the tools out there. Oh, and by the way, he is the ripe age of, I think, around 70, mid 70s, 73 or something like that. All right, folks. Eric, forgive me for going this long without asking my co-host to speak. Please go ahead.
No problem. Good morning, gentlemen. I just want to mention regarding that whole Scott Besson thing and some comments I've had yesterday. I want my audience not to get misled by comment that can make on one space or another. Timing matters. So when I tell you that what Scott Besant is doing is bullish gold, don't wait till 2 weeks, 3 weeks after something happens to enter your position. If you do it on the day that the news comes out, maybe the next day, because sometimes some people work at night shifts, whatnot. It's okay, you can do it the next day, and you do it calmly. But you don't chase it when biting your fingers that, oh, I missed the trade, then I chase, when it's 10% up or 20% up from where you were supposed to enter. Just be careful of that, because a lot of people procrastinate and then they try to enter what is when your risk reward essentially goes down. So timing matters a lot. Another comment I made is that I try to keep, like Warren Buffett, very little positions. He has 4 or 5 for that because he invests in the very long term and medium term. And then people, some day traders and rapid traders, they invest every day. You will see them in spaces. Every day they're looking, what's the trade today? What's the trade today? I mean, Nikoski is also a rapid trader sometimes, and he looks at the charts every single day. And when you're like him, you can have 20, 30 different positions, even more, depending on what the chart's telling you. He will just follow the charts and what they say. So you can have a lot of positions. I like to have the stars align when I go into a position so that I have far less opportunities to get into a trade. But when I do, there's very, very little chance that it will turn on me. So usually it'll be very, very positive. And that's just a way of trading and or investing, I would say, which matches when you have another job that you do, because you cannot be the holder on the markets looking at every chart and whatnot and scatter yourself in 20, 30 different positions. So if you are like 90% of the people and you have your own job and you have your own thing that you do every day, then this is a good way to be, that you really select and take your time to select what you're going to get in, and you have time after that to get out. It is to me the most efficient way, which is why you see me having very little positions, and I like it that way. I really like it that way because it gives me more time. That doesn't mean that you see I am on the Finance Daily every day. I talk with my fellow co-panelists and a lot of people of the audience every day. I'm still active. That doesn't mean that I have to be in a position, right? You have to be patient, and then if you feel like yes, because this is the big question, and I sorry, David, for repeating every 2 3 months on the space this, but I have to repeat it. Only enter a position when you know why and what and when you get in, and then why and when you get out. If you don't have the answer to that, don't get in, please. This is very essential. And might be many positions that you are tempted, but you don't know enough of that sector or what is affecting it that you would know why and when to get out and stay away from it. That's my advice. Always understand enough so that you can comfortably get in and comfortably get out, not being wondering, okay, what's going to happen? I don't understand, right? Because then it's going to hurt you psychologically and it might hurt your portfolio as well. And you don't have to rush into things. There's so many opportunities that come month after month, year after year, even on this show. So you don't have to stress about it. Yeah. I just wanted to make sure people understand that. Back to you, David.
Super. Thank you for all of that, Eric. Matthew, it is always a pleasure to have you up on stage. Please, good morning.
Good morning, David. Good morning, everybody. Just wanted to touch base and kind of think about what Carla was talking about with respect to tokenization here. One interesting distinction that should be made is that tokenized stocks currently are just an IOU. They are not anything particularly special in terms of adding additional value. They are simply an IOU. What we don't have currently in the United States is a stock token, which is sort of a different technical, infrastructure. And I think those are going to be coming, as we get just regulation moving into the space. But what we're seeing, to Carlos' point, with things like Coinbase and Robinhood Chain and even Kraken, like nobody recognized this a week and a half ago, but Kraken released their own chain called Ink. And like I didn't even recognize it. Everything is purple, and on Robinhood everything is green, and on Coinbase everything is blue. Like it's very clear that all these companies now have to start playing in this space. But it's important to recognize that tokenizing a stock does not add value. It doesn't bring money to the ecosystem. It doesn't make things more valuable. It just means that people can purchase them or trade them in different ways. So it's just important to recognize that these things are good for access, but they don't necessarily contribute to value in that regard. And I would push back slightly on the meme coin space. Like, yeah, there's some stuff that's going on in the NFT and meme coin space, but that's very PvP, very low like volume, very low liquidity. Like these people are in there making money, but they're taking money from other people. It's not value creation or value accrual in the same regard as like a company going up in value. This is just money moving from one place to another, and it's not growing the ecosystem. But what is really interesting, and I encourage people to look at this on Robinhood Chain, there are NFTs now. I just wrote about this earlier this week. There are NFTs now that are having their own balance sheets, and they have their own wallet structures, and they have their own ownership of how the tokenization mechanics are actually flowing. And that means that you can own an asset that now brings value accrual through an NFT through trading volume. And that's what's really cool to start seeing is now these NFTs are no longer just JPEGs or pixel art, and you're buying it for the art. Now they come with preloaded wallets and programmability that allows them to participate and engage in an ecosystem. And as an owner, you now have a right to some of those asset accruals and value. The one that you may have seen on the timeline is called Stonk Brokers. This guy, Simple Farmer, created this ecosystem and a sort of a launch pad that allows a lot of different things to happen on it. But what again is interesting is he's already talking about how the tokens themselves, not necessarily quote unquote passing the Howey test, but circumventing the Howey test in a way that is done in a computable way, which I think is really, really interesting. And so as we get more clarity, no pun intended, on this kind of infrastructure, I encourage people to think about how programmability in this space will be much more appropriate for value accrual than just the simple tokenization of these assets. Back to you.
Thank you, Matthew. Go ahead, Lumi. Follow up to you.
Yeah, I'm gonna address a few things real quick. So the Martin Shkreli thing with the meme coin, I think you might be talking about that, and it went to like 1 million immediately. I think you're right about that, but it is a sign that the market for crypto and things is getting frothy because this is kind of what Carlo is right. There's a pattern to things, and generally, it's normally two or three big crypto companies blow up or something goes wrong with them, and at the same time, a scam will happen, and at the same time, the meme coins start to kick off. So there is a pattern there, but it is what it is. I wanted to bring up the treasury thing again. I think only $1 billion of the four was actually, uh, honored. So it's not even a talking point. I just wanted to bring that up. And then the last thing is um, jalapeno. So everyone should be talking about the jalapeno chip. There's not a
Jalapeno.
so well. I, I'm from the UK, so I we don't even have any real good Mexican food there. So apologies
But you
immediately
but you
coming
do
up.
say herb because there's an H in it.
Either way, this is the point is that
Yeah, but I'm from Cuba, and there's no and the H is silent for Havana.
well, this is the key here. Richard Ho or Rich Ho, he's going to become a Rich Ho. Key to this whole thing, because at the end of the day, Nvidia is trying to eat OpenAI's lunch and Anthropic's lunch by making their own model, right? Open weighted model. At the same time, they're making their own chips, right? And they're trying to eat their lunch, but everyone's worried about commoditization of both of these two products. I think it's a great thing. And this is where what banks did in one way or another, if you think about it, all banks own other banks. One way or another, all these firms kind of own and control each other. And I think AI is going to end up being like this one massive ecosystem where they all have either a partnership, a contract, ownership, even through to memory. It's just going to be this convoluted mess. And it'll become very difficult for any one player to fail. But anyway, back to you.
Super. I did want to go back for a second to Matthew's point about tokenization of stock. So from what I understand right now, you do not have ownership of that stock directly, right? It is an IOU in that sense. Um, but in terms of increasing value, there is a lot to be said for if there is additional liquidity in an asset, then the price of that asset, to the extent that it's valuable, should trade up, at least to its whatever you want to call it, appropriate market value, intrinsic value, whatever it may be. So if there is more liquidity in the asset, simply by function of the fact that it is now available on platforms that people who would otherwise want to invest in that stock would not otherwise access. And now they are able to access it because it's through a platform that they're often trading through, then that creates liquidity, which would then drive the price higher. But
But
that's just, yeah.
David, it's the same number of outstanding shares. If you're trading
Agreed,
Robinhood stock
agreed.
or
I agree
Tesla,
100%. But again, the argument has to be the person, the investor that is buying on that platform does not have, let's say, an equities account, right? They only have a Robinhood tokenization stock account, right? And so therefore it is bringing additional participants to the market. Now, am I saying that that is the case? I am not saying that, but that is the idea behind creating additional liquidity. I agree with you. It does not do anything for the company. It does not create more shares for the company. It simply creates potentially a larger buyer pool for the company's stock. That's it.
but doesn't it also conversely create a concern from a like counterparty perspective? Because now you've got outstanding tokenized products that are an IOU. It's basically a default swap or some sort of
Oh
swap
yeah,
on an
no, no,
asset.
no. Listen, I'm a cash guy. I'm not a derivative guy when it comes to everything, equity, credit, or otherwise. So yes, I agree with you. There is a legal problem, and they better fix that problem or figure out how it all unwinds very nicely and neatly before the first crisis happens. I'm totally on board with you when it comes to that. Yes, everything is rah, rah, rah on the way up. And on the way down, it turns into one gigantic mess. And yes, they better figure that out. And my hope is that they will figure that out. They, not just the platforms themselves, but the along with the SEC and the CFTC and everybody else that needs to be involved regulatorily before there is, either a hiccup or much worse than that.
David, can I add to
Yeah,
what Matthew
yeah,
just said and what you
yeah.
brought up? I liken what's going on right now to basically the test net stage of this, because I recall hearing Sandy over at Templeton talk about this very issue, and I asked her about tokenization of stocks and the amount of back end that's going to have to be changed in the stock exchanges and the way they settle these funds is massive infrastructure change. It is going to happen, but I think what we're seeing right now is the first iteration, the test net of this, because you're absolutely right. If it's going to go live and actually move value on chain and affect the balance sheets of these companies, then the infrastructure and the settlement layer has to be perfected. And I think we're going to get there, but we, of course, need regulatory clarity, like Matthew said.
The real unlock is what Brandon talks about all the time is the illiquidity of special purpose vehicles and private investments. That is going to be a tremendous unlock for people. And a lot of, I'm trying to work on that, but that is where you're going to see a huge unlock of value because now that liquidity can go somewhere else rather than just being in a pool that's mixed together of people buying and selling Tesla or Robinhood.
Super. Go ahead, Brandon. Over to you.
Yeah, thanks for bringing that point up.
I got you,
You
Brandon.
knocked it out of the park. To me, I 100% believe that's going to be the biggest win of this cycle. One thing I just want to say real quick is like I despise NFTs. I'm going to beg people not to get into NFTs. I just saw. So I know, Carlo. I'm sorry. I'm all for stable coins. I'm all for all the other stuff you talk about. But NFTs, man, I just saw way
I
too many
have to
people.
second that completely. NFTs are a total waste of time. I'm a
You
pianist.
guys are
I want a
you
Monet. I
guys are
don't want some
completely
some
wrong.
some digital BS. I'm
You're
100%
completely
there.
wrong. You're completely
I'm
wrong.
gonna third that. I'm gonna third that as well. It's crazy to buy a website domain like a JPEG. What are you doing?
You guys are just so wrong. You're thinking 2021. Like these things are
Yeah,
programmable assets right now. Stop calling
listen,
them a
you might be,
non-fungible token.
but that's what
Can I
people are
use it
saying
as
as NFTs. That's what
can I use it
that's what
as
people were
That's
saying.
a
collateral?
marketing problem, not a functionality problem.
Could
Is it
be.
collateral?
Yes, they're collateral. They have tons of functionality now. Like I don't know why you say I hate these things. Like they're literally going to be the way that we package
Hate
securities
is a
together.
strong word. Hate is a strong word. But listen, Japan
I
right
hate.
now, they're gonna tokenize everything. So they'll be able to tokenize all their art as well. And we can buy it back off them, these Japanese gorillas for hundreds of thousands of
Let's
dollars.
not do this now,
Yeah,
folks. Wait.
yeah, yeah,
We're
yeah.
going to do this intelligently one day. I think Anas may have turned into a pumpkin because it's so late in the show. Anas, are you here? Because we need an energy update.
I am here. um,
Please.
good morning, everyone. All right. Oil prices declined by about 3%, and Brent is below 87. The media and some analysts are telling us it's due to easing concerns over supply disruptions through the Strait of Hormuz. Well, nothing changed at the Strait of Hormuz. The fact is, we had a major decline in Kazakhstan, and that's in exports of crude. In Kazakhstan and Russia, that kind of recovered, and then the same thing for North and South America. So it's not about sentiment as much as about fundamentals that whatever we lost, the Libyan oil is back, etc. Iran announced an agreement with Oman to share the Straits waters as well as the revenues. And it wasn't the Iranian government who announced that, it was the IRGC, that the Islamic Revolutionary Guard, that announced that. And that means nothing to anyone simply because if people do not want to pay, then there is no money. And the US, of course, is there. We've been told that the US Navy is arranging traffic in the Hormuz Strait. It seems that we do have higher activity in the Omani lane. but we don't know much, and the data is so messed up. And I'm going to show you in a minute why the data is so messed up. It's not about what the US government is saying and the tracking companies are saying. I'll explain that in a minute. We are still assessing the impact of the Hormuz crisis. And this was predicted by almost everyone long ago that, look, it will take us a long time until we comprehend what is the impact and the final impact of the Hormuz crisis. So we are still learning. Every single day, we are learning something new about the impact of the Hormuz crisis. And what we learned recently is that India has become a large supplier of petroleum products, especially gasoline, diesel, and jet fuel, to Africa, especially Eastern Africa. And it did replace the UAE and Saudi Arabia in the supply of gasoline and diesel to Kenya. So the number one supplier of fuel to Kenya is Reliance Energy of India. This is of special importance because of the following. Again, when we talk about debt, you talk about inflation, you talk about all the related macro issues. The reason why Kenya was importing from Saudi Arabia and the UAE, because the companies in those two countries kind of tried to help Kenya because Kenya is struggling financially. They told them, okay, you can pay 6 months later. So we don't know what type of deal they made with Reliance, or whether Reliance is acting on behalf of ADNOC and Aramco. And we don't know those details. But if there is some sort of cooperation, again, we are talking about the Hormuz impact. This is just amazing to see how companies, basically global companies, are working with each other to kind of mitigate the impact of the crisis. And I hope we are not going to have some nuts in the Congress who are going to investigate this as some sort of a monopolistic thing going on around the world. Ukraine attacked more refineries in Russia. Here, I would like to emphasize a very important point. If you look at the map and where the um, attacks are happening, logically speaking, if you are Ukrainian, you would attack the refineries that supply the fuel to the Russian army and to the Russian planes. But to go out of your way to attack the refineries that are meant for civilian use on one side and for exports, that gives a completely different meaning to the war. I've been talking about this, and Eric been talking about this for a while. Ukraine is a proxy war between the United States and Russia, and it was Putin's plan to diversify oil exports to the rest of the world after the sanctions that have been imposed by the G7 and the EU. And when Lavrov basically went around the world, especially to the poorer countries, trying to tell them, look, buy my crude and I'll get it's easy credit, you can pay me later, etc. He came back with a very important result that those poor countries do not have refineries. And therefore, Russia has to expand its refining capacity so they can export the crude in the form of gasoline and jet fuel and diesel, etc. It was a strategic decision by Putin to be able to generate revenues and diversify, and the United States found out. And as a result, the decision was made to hit those refineries so Russia will not have that strategic advantage. Now, back to the deterioration of data. ADNOC, that's Abu Dhabi National Oil Company, one of the largest in the world, one of the most active in terms of investment in the world, especially in LNG, made a deal with Iraq to help Iraq basically export its oil through the Hormuz Strait. And Iraq is giving massive discounts. So while oil prices were at 90, Iraq was selling its oil at 50. So there is a $40 difference per barrel. But if you look at the actual cost of taking it out, it is about $10 to $12. So anyway, who is able to get it out makes millions of dollars on each shipment. It is a very attractive business. So if you think of Michael Rich, we have 20 of them right now. So what happened is ADNOC was very successful in its operations of doing ship-to-ship transfer. And we have every single night, we have tens of them. So it was successful with Iraq. Now they made a deal with Kuwait. So what happened is the tracking companies now might end up reporting very high exports from the UAE, but really those exports are coming from Iraq and Kuwait. So we have more data deterioration as a result of those deals. And because we have many groups involved, I will not be surprised one day if we learn that part of this big scheme among various groups, various companies, various countries, that Iran was taking advantage of that and exporting its oil through the Omani lane. Just wait for it. The Brazilian government decided to extend the gasoline subsidy until September 9th. This is very important because of all those who are interested in the macro, interested in inflation and unemployment and economic growth, etc. Let's remember the following. The crisis, this Hormuz crisis, the massive increase in energy crisis and everything else has a very negative impact on the macroeconomy of every country. But we did not see that much negative growth around the world, especially if you look at Europe, for example, and the EU, although they've been hit really hard. Well, the main reason is the massive amount of government intervention, especially in the second quarter. And you go from India to South Korea to Vietnam to Brazil to every single country in the EU. There was massive intervention. In the EU alone, subsidies to fuel and energy, and that's for the consumption, by the way, this is not for production, for the consumption, amounted to about $16 billion. That's only in the second quarter. So we cannot argue that the impact was very limited of Hormuz because of those subsidies. The impact is huge. And the problem is, if the Hormuz crisis is going to last for a very long time, like we discussed yesterday, it might last for years. Those countries cannot afford basically to pay $16 billion every quarter for the next few years. The debt crisis is going to mushroom and is going to explode. So we are going to have serious problems. So the bottom line here is something got to give when we talk about those subsidies. So every time you see a news about subsidies, don't take it just as the news about subsidies. This is going to affect your life even if you are in another country. We do have enough evidence. Back to the idea of proxy war. The Wall Street Journal today published a report saying that what changed the war with Iran basically is the Shahid drone, and it did transform the war, and the Iranians became more effective in hitting targets. And they looked into it and they found out that China had been heavily involved in that. So you want to talk about proxy war? Well, here is another evidence. Speaking of China, the Chinese President Xi Jinping will visit Egypt for the first time in a decade. This is a very important visit for several reasons, whether you talk about it in terms of politics or you talk about it in terms of economics. And whatever I'm going to say here, this is just an opinion, and there could be kind of contrasting opinions on the other side or different opinions from what I am saying. But Egypt feels isolated. Egypt feels that's being kind of let down by the Trump administration and by the EU. And if you look at the countries that have been affected the most by the Hormuz crisis, they have nothing to do with the war. That's Iraq and Egypt. So Egypt is far away on the other side, but they ended up losing. And the issue here is the Trump administration did not do much, and the EU did not do much. And because they have some issues with the Gulf countries, they cannot get the whatever help they need from the Gulf countries. So China basically is taking advantage of this situation and coming to Egypt. So think about the implications of that. The other issue is that Egypt now, because of what the Houthis did in Bab el Mandeb, has become the center of gravity for shipping the Saudi oil to China and the rest of Asia. So, as you all know, and we explained this before, how the Saudis basically are exporting the oil through smaller ships through Suez Canal, and for the VLCCs, basically they are doing it through the Sumed pipeline to see the Creer on the Mediterranean port. So this visit is extremely important, whether you look at it in terms of politics or economics, in light of what's been going on. When it comes to Japan, as you know, we discussed Japan several times, especially when it came to the devaluation of the currency and the price of oil in that currency, etc., and the use of its strategic petroleum reserves. Now, Japan basically is working on a new energy security plan, and looking at that energy security plan, there is something funny about it. When it comes to energy security, Japan is the most paranoid country in the world. You can look at it even 50, 60, 70 years ago. They've been always paranoid when it comes to energy security. And the problem is, every time they want to have a new energy security plan, they go to square one as if they never learned something before. I mean, they went through crisis after crisis after crisis, and always they start from zero as if they learned nothing. And I mean, whether you talk about the loss of contracts in the neutral zone in the Gulf, or Fukushima, or anything else, it just kind of they go in vicious cycle, and that's their problem. That this is one of the problems. Therefore, Japan is going to suffer from energy crisis after energy crisis, whatever they do. And the problem is, and for those who have experiences with Japanese businessmen and officials, they do not listen. They do not listen. So you are sitting with them, they want to tell you what they want to say, but they don't listen. Finally, today, the EIA will release inventory numbers, and here is the problem. That's the US EIA. As you all know by now, the oil market crisis is a diesel crisis. And to produce diesel, we need medium sour crude to produce it. And the US rescued the world by releasing medium sour crude from the strategic petroleum reserves. But looking at the numbers in recent weeks, most of the releases were light sweet crude, which means that we don't have enough medium sour to support the market. And if the Hormuz crisis is going to last longer, brace for major crisis. And finally, in my world fall speech tour kicks off next week. I'll start with India, and then I'll be with you guys most of the days, but I will tell you where I will be at that time. But next week, I'll be in India. Back to you.
Thank you, Anas. You have lots of questions from our speakers, so we'll go through that. It'll be Dave Levinson, then Ravi, then Eladio, and then we will close. But stick with us, Anas, because the rest of the show is yours, my friend. Go ahead, Dave Levinson.
Two quick points. One is Anas just pointed out there's a $16 billion subsidy. And that is why this conflict is going to end. Because the Philippine Central Bank leader said their currency is too strong. They cannot export enough and they're importing too much. And when you have to subsidize, what's happening is you're going to weaken these currencies, and China is going to see a lot of their customers become their competitors because of the relative 3.5 year high versus the dollar for Chinese currency, and these emerging markets are melting down. So one of the reasons the war can't go on is because it's terrible for China. And when Anas says Iran's really just a proxy, he nailed it. But you have to watch these currencies. The second point I posted up in the nest is why I think oil goes much lower, and not much more time to do that. Look at the volatility of oil. It's melting. Why is it melting? Because you were incentivized to buy oil to influence CPI, to get Powell to jack up rates, and then you have more liquidity in the system. War says, I'm not going to react. I'm letting the kurtosis rise. I'm letting the volatility rise in the 2 year. I'm not going to react. So now financial oil is selling. It's 50 to 1. It's 5 billion barrels a day versus 100 billion barrels. 100 million barrels a day of physical. So you're seeing the compression of oil volatility, OVX. It's about to break down. And when you do a cross product, it's already breaking down. So this is the test. This is our experiment whether financial oil is a thing, because oil is an infinite negative duration asset like silver, gold, and Bitcoin. And you'll watch it, and you'll watch oil go lower because the flatter curve means you cannot justify buying it as a financial oil. You want to take the other side. Well, thank you for the time.
You got it. Oh, before I get to Ravi, Meta has a deal to pay 16. Wow, off of the $200 billion number that was asked and demanded by the 29 states. The payment is going to be $16.7 billion to be paid to the 29 states in settlement. So it seems to be that deal is now going to be over. We will wait and see for the commentary all around on the number and on the settlement. Ravi, go ahead.
Just on a lighter note, Anas, your tweet has gone viral all over India about the Kenya and India thing. But I just wanted to understand one more thing. If you can get deep dive, where do you see the future? Because definitely India is processing and so on and so forth. Post the Hormuz crisis, where do you see this moving? And sadly, I'm not in India, but I would love to show you around. But again, welcome to India.
Thank you very much. I mean, and I'm going to speak in general sense simply because there is not enough time to explain these in details. But what's going to happen is for India and the rest of the world, they are going to adopt the Chinese model, and the Chinese model basically is making all the extractable resources, especially minerals and energy, a national security issue. And the United States made it that way anyway. But this is on a bigger scale. So it becomes a national security issue. And when it becomes a national security issue, you can justify subsidies, you can justify tax breaks, you can justify the government taking over businesses, you can justify the government basically having joint ventures, etc. But that's where we are going right now because this is a major national security issue. So that's number one. And part of that, for those who are interested in thinking about, okay, how I can benefit financially from it, we are going to see more emphasis on storage, whether storing oil or natural gas or electricity. We are talking about storage batteries here. So these things are going to be really big in the future, and we will see governments basically spending a lot of money to expand their storage, whether in joint ventures with the private sector or on their own. We will see countries within OPEC or OPEC Plus going out of their way to convince other governments around the world to allow them to store oil in them, including India. So India basically has a very good chance to convince those countries, look, go ahead and build my strategic petroleum reserves. I'm not going to pay a penny. I'm going to just kind of ease the regulations where you can come in and invest and build those inventories. And if there is a crisis, I will benefit from it. And if there is a crisis and I need to export your oil, I will export your oil according to my regulations. So there are many benefits to both sides in this case. Investment in renewables basically is going to go up. I think the Trump administration and Trump himself did a great favor to climate change in so many ways when it comes to solar, wind, and EVs. I think we will see kind of an uptick in building them and their use again because of what happened in Hormuz. The issue here is this going to be a one-time thing, or this is going to be a continuous growth over time? We don't know. Back to you.
Thank you, Anas. And the last question from Eladio. Go ahead, Eladio.
All right. Anas, Operation Economic Outcast. I hear everything you say, and thank you for that information about what type of crude is needed for diesel. You know, that's something I learned today. I can only go so much into your sector. Uh, I mean, to me, yesterday was an announcement that we were willing to put the account balance that the Treasury has at the Fed in order to back the war effort. And Bessent came out and did, and announced Operation Economic Outcast. I saw a BBC interview that said that that a family that earns in a month now has to consider what they're buying at the end of the month be in order to make ends meet. The prices are, I mean, the inflation rate is outrageous. So my question is, I believe Iran could survive into it for the rest of the year, but they would collapse in 2027 if this continued and more pressure. And then the last thing that they could do is sanction China, which they didn't announce and probably won't, but that's another arrow in the quiver because I do not think this administration is going to allow them. They're willing to take the political hit. And if you're willing to take the political hit, that's a big message they're sending the Iranians. Uh, and I believe the US could sustain this, not the global economy, but the US could if needed. What's your opinion on that?
Yesterday we covered this, and the bottom line. I know we don't have enough time here, but the bottom line on this: you cannot kill the horse twice. And whatever you mentioned about Iran, we heard it 20 years ago. We heard it 10 years ago. We heard it 5 years ago. We heard it last year. And now we are hearing it again. So there is nothing new at all. And you cannot kill the horse twice. When
Well, well, we did attack them and destroyed their army. I
and
mean,
yet we
you
sat
can't
down with
say
them.
it's the same thing.
Yet we sat down with them on the table to negotiate, and they walked out. So we got to remember that. The
Their
issue here is
currency is below
notice
2
the
million
following.
now.
Notice the following, because
I think they collapse in 2027, my friend. No way. They
all
don't
right,
make it.
then I'll stop here. I'll stop here. All right. You all have a great day.
Anas, you're the best. We love you,
A
sir.
currency below 2 million, a currency below 2 million is a serious thing. The middle class, ultra religious who believe in the IRGC and the Ayatollahs, they're losing money. You cannot have middle class people see the collapse of currency. They feel the pain. And they're going to say,
No, no,
let's
you're forgetting China pumping in and Russia. You're totally missing the point.
the currency is going down. That's a measurement. It's geometry. It's not an opinion. It's at a new record low. It's reducing the value of assets. It's triggering capital flight.
Hold on a second. I want to put a word here. Gentlemen, sanctions have been going on forever in so many countries. I was discussing this with somebody else on Twitter just this morning. What they do usually is destroy the poor people, not the ruling class. They still have money. Even if you reduce by 80% their money, 99% their money, they're still fine. The poor people starve. And what it usually does, if you look at all the other countries we have sanctioned, it either motivates them to go nuclear, case in point, North Korea, or it escalates the conflict. But very rarely do you see the leadership falling down. Did Vladimir Putin fall down? No, he didn't either, right? So sanctions really don't have the effect that you want on the government. It has it does have a terrible effect on the population, and it just pushes escalation of war slash going for nuclear, which in both cases I don't see how it is in the benefit of the planet at large, but it is definitely in the benefit of the war machine, which wants it so badly.
Don't underestimate the mafia president we have that will go to any lengths to do and what he wants, and he is going to win this one, my friends. He was the only one that had the testicular fortitude to attack this country after 42 years of war against the United States. This is different.
Okay, on that note, we're going to close it up for today. Market is open, everything's down just marginally on the equity side. This was a great discussion today. Once again, thank you very much to everybody that participated. Even though Eric's giving me a thumbs down, I think it was a good show. I'm kidding, Eric. You must have slipped, I'm assuming. In any event, everyone have a great day in the markets. We will catch you here tomorrow morning at 8 a.m. Join us, please. Thank you. We'll see you then.